Imagine this. One ordinary Tuesday, you simply aren't here anymore. The alarm still rings, the mortgage is still due, the children still need feeding and clothing, and someday, university. Now ask yourself, gently, who pays for all of it? Rather a heavy thought, I know. So let's set the fear aside and turn it into a plan. Because there's a perfectly ordinary financial tool built for exactly this moment, and most people understand it terribly poorly. Allow me to explain. Life insurance is, at heart, a promise. You pay the insurer a small amount on a schedule called a premium. In return, if you die while covered, they pay a large sum, the death benefit, to the people you choose. And here's the rather wonderful part. That death benefit lands in your loved ones, hands free of income tax, as a rule. A modest river of premiums on your side, a reservoir of protection on theirs. That is the whole machine, really. The money isn't for you, of course. You shan't be here to spend it. It's for them, to replace the income you can no longer provide, so the people you love keep their home, their plans, and a little breathing room while they grieve. Now, here is where most people get marvelously confused. When you go shopping for cover, you face two main contenders, and they could hardly be more different. In the blue corner, term life. In the red corner, whole life. Let the bout begin. Contender 1, term life insurance. The clue is in the name. It covers you for a set term, typically 10, 20 or 30 years. If you die during that window, your people get the payout. If you outlive it, the cover simply ends. Term is gloriously simple. Pure protection, nothing fancy bolted on. No savings pot inside it, no investment, no cash value building up. You're renting a safety net for the years your family most depends on you. That's it. That's the lot. And because it's so simple, it's astonishingly cheap. A healthy 30-something can often insure a healthy 6-figure sum for the price of a few coffees a month. That affordability is rather the entire point. Big protection, small premium. Contender 2, whole life, sometimes called permanent insurance. As the name suggests, it doesn't expire after a term. It's designed to cover you for your entire life, so long as you keep paying. The payout is, in theory, guaranteed to arrive eventually. But whole life carries a passenger, a cash value account. A slice of each premium is set aside and grows slowly over time, a little savings pot you can sometimes borrow against. Sounds splendid, doesn't it? Do hold that thought for a moment. So picture the contest like this. Term is a lean sprinter, fast, cheap, built for a fixed race. Whole life is a heavyweight, slow, costly, but it never leaves the ring. Two very different fighters for two very different goals. Before we crown a winner, let's see how the price is set, because it's not plucked from thin air. Insurers are, frankly, professional guessers. They estimate the odds of paying out, then charge accordingly. 4 things mostly decide your premium. Factor 1, your age. The younger you buy, the cheaper it is, because the odds of paying out soon are lower. Factor 2, your health. Hence the dreaded medical exam, where a nurse measures, weighs, and quietly judges your every habit. Factor 3, how much cover you want. A larger death benefit naturally costs more. And Factor 4, the type and length, term or whole, 10 years or lifelong. This whole appraisal is called underwriting, the insurer working out your personal price. Here's the bit worth tattooing on your memory. Whole life costs roughly 5 to 15 times more than the same amount of term cover. Not a touch more. Many times more. That gap is the crux of the entire decision, so let's understand it. Why the chasm? Part of it pays for that lifelong guarantee and the cash value pot. But a goodly chunk vanishes into fees and commissions, especially in the early years when your cash value grows dreadfully slowly. Patience is required, and money. So, which wins? Let me hand you the phrase the financial world repeats like a mantra: buy term and invest the difference. It's not gospel, but it captures something genuinely powerful, and the arithmetic behind it is rather persuasive. Picture 2 people. Both want protection. One buys pricey whole life. The other buys cheap term and takes the money saved, that big difference, and quietly invests it month after month in something simple, like a low-cost index fund. Over 20 or 30 years, that invested difference can grow into a sum that often dwarfs the cash value the whole life policy quietly built. Same protection during the risky years, frequently more wealth at the end. The maths tends to favor the patient investor, which is why the common guidance from a great many independent experts is delightfully blunt. Most people simply need term. Pure, cheap protection for the years your family leans on your income, paired with steady investing done separately. 2 jobs, 2 tools. Now, I shan't pretend whole life is useless. For certain wealthy estates, complex tax situations, or lifelong dependents, permanent cover has a genuine place. But for the ordinary household with a mortgage and children, it's usually a frightfully expensive way to do a simple job. Right then. Suppose you're persuaded that term is your tool. The next question lands immediately. How much cover should you actually buy? Too little and the net has holes. Too much and you're overpaying. Happily, there's a tidy rule of thumb. The classic rule of thumb is roughly 10 times your annual income. Earn $50,000 a year? Aim somewhere near $500,000 in cover. It's only a starting point, mind, not a sacred law, but it gets you in the right neighborhood. Then adjust for your real life. Add your remaining mortgage. Add future university costs for the little ones. Add any debts. Subtract savings you already have. The goal is a number that lets your family carry on without your paycheck for years. And do beware a common trap. That small life policy from your employer. Lovely perk, but it's often only a year or 2 of salary, and it usually vanishes the day you leave the job. Treat it as a bonus, never as your whole plan. One more gentle truth. Even non-earning parents deserve cover. If a stay-at-home parent were gone, someone must pay for childcare, cooking, and the 100 unseen jobs they do. That work has real value, so it deserves a real safety net too. So how do you actually do this? Step 1. Work out your number. Spend 10 honest minutes adding up the income, mortgage, debts, and future costs your family would need replaced. A simple online calculator does the heavy lifting beautifully. Step 2. Choose your term length. Match it to your years of greatest responsibility. A common move is a term that runs until the mortgage is cleared and the children are grown and self-sufficient. 20 or 30 years suits a great many families. Step 3. Shop around and compare quotes from several insurers. Prices for identical cover vary surprisingly. Be honest on the application, sit the medical exam, and resist any slick upsell toward an expensive permanent policy you didn't come in for. Step 4. And please don't skip it. Name your beneficiaries clearly and keep them updated. Marriages, divorces, new children, all of it. An out-of-date beneficiary form has sent many a payout to entirely the wrong person. 5 minutes now saves dreadful tangles later. And then invest the difference. Take whatever you saved by choosing term over whole and put it to work, perhaps in a low-cost index fund inside a retirement account. That, my dear viewer, is the second half of the famous phrase, doing its quiet magic. Let me reassure you before we wrap, none of this requires wealth or a finance degree. It requires one honest afternoon and a few simple choices. The hardest part is starting, and you've already done the thinking part by staying with me this far. So, the recap, served neatly. Life insurance pays your loved ones a tax-free death benefit if you die while covered, replacing the income they'd lose. You pay premiums set by your age, health, cover amount, and policy type. Simple promise, profound purpose. There are 2 contenders. Term is cheap, simple, time-limited pure protection, and it's what most families need. Whole life costs roughly 5 to 15 times more, lasts forever, and builds slow cash value, which suits only particular, less common situations. And the playbook. Buy term and invest the difference. Aim near 10 times your income, adjusted for mortgage and family. Compare quotes, sit the exam, and for heaven's sake, keep your beneficiaries current. Protection here, investing there. 2 tools, 2 jobs, done. One honest note before you go. This is education, not financial advice, and every family is different. The figures I've mentioned are simply 2025 style examples, and rules of thumb are just that. Do check current numbers and consider a fee only professional for your own situation. Now, a question for the comments, and I genuinely want to know, did anyone ever properly explain life insurance to you before today, Or did you, like most people, have to puzzle it out alone? Tell me below. I do read them. And if this brought even a little clarity to a heavy subject, do return the favor. Tap like so others, find it, subscribe for one splendid explanation at a time, and share it with someone you love. Look after your people. Cheerio.